Have you ever wondered how startups turn into multi-billion-dollar companies? What powers their growth? It's not just a clever idea or a groundbreaking product that propels them to stardom. It's funding, a crucial fuel that supports these businesses, enabling them to scale up, hire top talent, and make their mark in the competitive market. Imagine a seed. Without water, sunlight, and the right soil, it can't grow into a mighty tree. Similarly, an idea or a startup, no matter how brilliant, needs the right resources to flourish. And that's where funding comes into play. Let's talk about the three main types of funding that are often the lifeblood of businesses, particularly startups. They are venture capital, private equity, and angel investing. Each of these plays a unique role in the business ecosystem, providing the much-needed capital and strategic support to businesses at different stages of their life cycle. Venture capital, or VC, is typically associated with high-risk, high-reward investments. Venture capitalists invest in startups that may not have a proven track record but show high growth potential. They provide these fledgling businesses with the capital to scale and the strategic guidance to navigate the choppy waters of entrepreneurship. Private equity, on the other hand, is more about investing in established businesses that need a capital boost to expand or improve operations. Private equity firms buy a significant stake in these companies, often with the aim of improving their financial health and selling them for a profit down the line. Lastly, we have angel investors, often successful entrepreneurs themselves, who use their personal wealth to back promising startups at their earliest stages. They not only provide capital, but also mentorship, sharing their experiences and networks to help these startups succeed. These three types of funding are like the water, sunlight, and soil for businesses. They provide the resources, guidance, and capital that businesses need to grow, scale, and realize their full potential. So let's delve deeper into these three powerful forces that propel businesses to new heights. Scene script. Imagine if you could inject rocket fuel into a business to skyrocket its growth. That's what venture capital does. Venture capital, in essence, is the financial backing that turns the gears of innovation, allowing startups and early-stage companies to transform their groundbreaking ideas into reality. It's a form of private equity, a type of financing that is provided by firms or funds to small, early-stage, emerging firms that are deemed to have high growth potential. But venture capital is not just about writing checks, it's about taking risks. Calculated risks, yes, but risks nonetheless. Venture capitalists invest in these high-potential, high-risk companies with the understanding that while some of these investments may fail, others could yield astronomical returns. This high-risk, high-reward dynamic is the lifeblood of venture capital. Venture capital plays a particularly significant role in the tech industry. Think of some of the biggest names in tech today, companies that have become integral parts of our daily lives. Odds are, many of them got their start with venture capital. It's what allows these businesses to grow at an accelerated pace, to hire top talent, to scale their operations, and to innovate relentlessly. But it's important to remember that venture capital is not just about the money, it's about the expertise and networks that venture capitalists bring to the table. These seasoned professionals often provide strategic guidance to the companies they invest in, helping them navigate the choppy waters of the business world. They can open doors, make introductions, and provide the kind of mentorship that can be invaluable to a fledgling company. However, venture capital isn't for everyone. Not all startups will fit the venture capital model, and not all entrepreneurs will want to give up a share of their company in exchange for funding. It's a high-stakes game, with the potential for both massive success and notable failure. Venture capital provides the much-needed lifeline to startups, but it's not the only game in town. As we will explore further in the next scenes, there are other financing options like private equity and angel investing that can fuel the growth of a startup. What if you could take a struggling giant and turn it around? Welcome to the world of private equity. Private equity is a fascinating realm of finance where investors, often organized into funds, buy controlling stakes in mature companies. Unlike venture capital, which we discussed in the previous scene, private equity focuses on established, typically struggling companies rather than budding startups. It's like buying a fixer-upper in the world of business, where the goal is to renovate and revive, rather than build from scratch. The private equity process usually begins with a buyout. Investors acquire a significant chunk, often the entirety, of a company's equity, effectively taking control. But the journey doesn't end there. The objective is to make the company profitable again, which can involve restructuring, streamlining operations, or even merging it with other companies. This process can be likened to a caterpillar's metamorphosis into a butterfly. It involves a lot of change and can be quite challenging, but the end result can be truly transformative. One of the potential outcomes is job creation. When a company is effectively turned around, it often needs more hands on deck, leading to an increase in employment opportunities. Moreover, a revived company can contribute to economic growth. When businesses thrive, they generate more revenue, which can lead to increased spending and investment, fueling a cycle of prosperity. However, let's be clear, private equity is not a magic wand. It requires a keen knowledge of the industry, a clear vision for the future of the company, and a substantial amount of capital. It's a high-stakes game where the risks are significant, but so are the potential rewards. So, while venture capital fuels startups, private equity revitalizes mature companies. But what about the small players who are just starting out? Those who may not yet be ready for venture capital but have more than just an idea. Stay tuned as we delve into the world of angel investing in the next scene. Scene script. Imagine being the first one to believe in a winner. That's the opportunity angel investors seize. Angel investing, in a nutshell, is all about providing the initial financial lifeline to promising entrepreneurs. Picture yourself as a guardian angel, swooping in when a fledgling company is just taking flight. Your investment is the wind beneath their wings, helping them soar towards their potential. Often angel investors are successful entrepreneurs themselves, who have been through the grind, tasted success, and want to pay it forward. They bring more than just capital to the table. They bring experience, insight, and a network that can open doors for these budding businesses. Now let's talk about the role of angel investors in the success stories of some companies that you might be familiar with. Take Uber, the ride-sharing giant, for example. Before it became a household name and a verb in its own right, it was just another startup looking for funding. Along came angel investors who saw potential in the idea and were willing to take a punt. Today, Uber is valued at billions of dollars. Or consider WhatsApp, the messaging app that has become a staple in our lives. It too started small, with angel investors believing in its potential and providing the necessary funding. Today, it's hard to imagine a world without WhatsApp. Just like venture capital, angel investing can be a high-stakes game. The risks are high, but so are the potential rewards. The key difference, however, is that angel investing happens at a much earlier stage. It's about spotting potential before it's obvious to everyone. It's about believing in an idea, a vision, a goal, and most importantly, the people behind it. Angel investing is about betting on the underdog, the one that's just starting out, the one that's yet to make its mark. It's about believing in the potential of a David in a world full of Goliaths. Angel investing can be a high-risk, high-reward game, much like venture capital, but it's played at an even earlier stage. Venture capital, private equity, and angel investing. 3 different ways to fund businesses, each with its own risks and rewards. Let's take a closer look at each one and see how they stack up. Venture capital is the high-stakes, high-reward end of the investment spectrum. Venture capitalists typically invest in businesses with high growth potential, often in the tech or biotech industries. They usually come in early, provide substantial funding, and in return, they expect a significant piece of the pie. Their bets are risky, but when they can pay off big. On the other hand, private equity is a bit more risk-averse. Private equity firms usually invest in established companies that are underperforming or undervalued. They buy controlling stakes, streamline operations, and aim to sell at a profit. The risks are lower, but so are the potential returns. Angel investors, on the other hand, are individuals who invest their personal capital often in startups. They typically invest smaller amounts than venture capitalists and take a more hands-on approach, offering guidance and mentorship. The rewards can be significant, but the risks are high, as many startups fail. So, when is each type of investment appropriate? Venture capital is suitable for high-growth startups that need substantial funding and are willing to give up equity. Private equity is ideal for mature, underperforming companies that need a turnaround. And angel investing is perfect for early-stage startups that need not just funding, but also guidance and mentorship. As for the typical return on investment, it varies widely. Venture capitalists aim for a return of 10 times their initial investment, but many investments fail. Private equity firms typically target a 2 to 3 times return, while angel investors, given the high risk, often aim for a return of at least 10 times their investment. Whether it's venture capital, private equity, or angel investing, the goal is the same: to fuel growth, and drive success. But the strategies, risks, and rewards can be very different.